All right, hello, ladies and gentlemen. My name is Greg Michalowski, and I'm here to give a special webinar for FX Street. Honored to be here. Apologize for any technical difficulties last time I did this. I had trouble sharing my screen, so I'm trying to make sure that everyone can see the proper screens, and so apologize for being a little bit late here. My email address is greg@fxdd.com. My Twitter is gregmikefx. I'm also live on livestream.com/FXDD on a daily basis, starting at around 8 o'clock New York time and around 3:30 or 4 o'clock. As long as I'm not preparing for webinars like this one, or I'm off on vacation or stuff like that. I'm your source of education, my source of some foreign exchange trading ideas and stuff. So try me out at livestream.com/FXDD.com. Or not. It's livestream.com/FXDD. Before we get started, let me remind everybody that trading foreign exchange carries a high level of risk that may not be suitable for all investors. In addition to that, leverage creates additional risk and loss exposure. Should you or before you decide to trade foreign exchange, I would love for you to carefully consider your investment objectives, experience level, and risk tolerance. You can lose some or all of your initial investment, so be aware, be prepared is what I like to say. I'm not here to give buy, sell, or hold recommendations, but we are going to talk about going to take a look at some charts, going to look at some ways that you can analyze the market in a way that hopefully puts the odds of success in your favor. So let's get started. The topic of this program is 2 is better than 1. 2 is better than 1. And I was reminded when I thought of this topic, it was actually brought to my where I got the encouragement, I guess, from this idea was from a television ad whereby it's actually an AT&T 4G network ad, and this guy. There's a series of them on here in the United States. I don't know if they're on overseas, but I'll tell you a little bit about him. This guy sits around a table with obviously first or second graders, pretty precocious little kids, and he asks little questions in regard to what is better, fast or slow. And one of the things that he asks is 2 better than 1? And this little young boy over here gets really excited about the idea, and he says, 2's better than 1. 2's always better than 1. And then he goes, well, I can move my head around like this, and I can also move my hands around like this. So when I move my head around and my hands around, that is better than 1. And it's really a cute commercial, and it reminded me of the idea in trading, because 2 is better than 1 in trading as well. If you have multiple trading reasons, you're going to do better than having one trading reason. So if I took the idea of trading down to its most basic concept, what would it be? And for me, trading is not about what's happening in Cyprus. It's important, but it's not primary. It's not about necessarily what is the housing start data. That data is important, but it's not as important as other things. If I were to bring it down and say it's about the unemployment report or retail sales and stuff, all those things are fundamental things that move the market. They become the story for the trading day, and that is okay to have that bias. Okay, if the housing starts are better, maybe the dollar should get stronger. If the unemployment is stronger in the United States, maybe the dollar should get stronger. If Cyprus is an issue, maybe the euro should get weaker. If there might be a contagion because of Cyprus, maybe the euro should get weaker. If there's going to be a solution to the Cyprus and it's not as bad as what was originally thought, maybe the euro gets stronger. All those are the stories that are going to be written about in the paper. But for me, for me in trading, the most important concept, or the basic concept that I want to focus on as a trader, is trying to put the odds of success in my favor. Trying to put the odds of success in my favor. And if I can put the odds of success in my favor, then the chances are I'm going to win more than I lose, and hopefully I'll be able to keep my losses to a minimum and have my, because the odds are in my favor, because I'm confident in the trade, because I think the market is going to move, I'm going to have the ability to make more than I lose on the trades. Now, does the putting the odds of success in my favor actually make me guarantee that I'm going to make money? And the answer is no. Nothing guarantees you're going to make money in trading. All it does is it says that you have a better chance of winning. You have a better chance of the market moving. If you can put the odds of success in your favor, you have a better chance of winning. You have a better chance of making money in your foreign exchange trading. We'll expound on that as we move along. So, how are the odds of success increased in your trading? And it gets down to 2 is better than 1, or 3 is better than 1, or sometimes even 4 is better than 1. Like the little boy, 2 is better than 1. I can shake my head, I can shake my hand, I can do those things at the same time, and that's better than just moving my head. Okay, if I can do 2 things, that's better than 1. And if AT&T's phone, you can do 2 things at the same time, that's better than 1. Well, Apple can do it as well, but that is better than 1. So those are in trading. The same thing applies. If you can put the odds of success in your favor by finding multiple reasons to trade, by finding multiple technical reasons to trade, you are going to find that your trading gets better. It also allows you to be a little bit more patient in your trading. If you have to find multiple technical reasons to trade, you're not going to take every little move below the 100-bar moving average or 200-bar moving average. You're not going to take. You're not going to look for just one reason to trade. You're going to look for multiple reasons to trade. And if you have multiple reasons to trade, I think that you have a better chance of success. The more technical reasons to trade at an area or price, the better chance for success. The more technical reasons, the better chance for the success. The chance of success is actually has nothing to do with calling whether the market's going to move up or down. What multiple reasons actually do for you is give you the knowledge that the market price is going to move away. It's going to move away from this trading level. Think about it. If there are multiple technical reasons to trade, there tends to be an energy around that level. If you have a trend line, just imagine in your mind, and we'll go through some examples here in a second. If you have a trend line that's coming up, from the bottom to the top, and where the trend line is broken from the top, the market's moving above the trend line, the price is moving higher, and imagine in your mind, see the chart in your mind. Sometimes it's best to visualize these things, but see the chart in your mind where the price starts to break below that trend line. Well, that gives you a sell signal, right? The price was moving up. The price was moving up in a trend. The price moved below the trend line. That gives you a sell signal, a level to get out of your long position, a level to perhaps even go short. Now, imagine in that same chart that you have in your mind, imagine that a 100-bar moving average is coming across against that level. A 100-bar moving average is a moving average that I find is followed by a lot of market participants. Just like a trend line, it's visual. Just like a trend line, it gives you bullish above, bearish below. If the price is above, it's bullish. If the price goes below, it's bearish. And so now you have two reasons to trade. One, the price moved below the trend line, and two, the price moved below the 100-bar moving average. This is all in your mind's eye, and you can close your eyes and see this chart in your mind, or you can, I can see it without closing my eyes. But I see these formations, that show a key technical level. And if the price should break below both those levels, would you not expect that the market should move away from that level? And the answer is yes. I would expect that because this 100-bar moving average is followed by a lot of people, because this trend line is followed by a lot of people, and can be visually seen. I could see it in my mind's eye without even seeing the chart. But imagine that you're looking at your charts and you see a trend line, you see a moving average line, and they dissect at the same level. You're not the only one seeing that. All right? That's why I use technical tools that are very visual, like moving averages, like trend lines, because I want the market to see these lines. I want the market to have an energy around these levels. And that energy is going to be like a spring. And if it's broken, it goes further to the downside. If it stays and bounces off of that level, the price should move further to the upside. So it's not so much the directional move, it's what the market does at that level and the energy that is created at that level. That energy, or that area where we know there's going to be an energy, gives traders the ability to define and limit risk against that area. If you know that the market is going to do something at this trend line, at this moving average line, something, whether bounce off of it or move back to below it and head lower, you can define your risk against that line. If it bounces off of, if you buy it against that level, against that trend line, against that moving average, and you buy it on that dip against that level, and the market moves below that line, what are you going to do? Are you going to stay long in that position? No, there should be an energy that's going to force this price to the downside. So you get out. That allows you to define your risk and limit your risk. And if you're able to define your risk and limit your risk, you're going to only lose a little. That is important in your trading, to be able to define risk and limit risk and only lose a little. Now, let's take the other case where you go long against that trend line, against that moving average line, and instead of going through that level and moving lower, turning the bias from bullish to bearish, the market moves higher. Wouldn't you expect that energy off of that trend line that everyone can see, that moving average that everyone can see, wouldn't you expect that the market, in quotation marks, not you, not anyone in this room, but the market would get excited about the ability to stay above that trend line? And the answer is yes. That is the energy that develops at an area where there's multiple reasons to trade. So that energy gives traders the ability to define risk and limit risk against that area, and it allows you to take advantage of what should be a move away from that level. That should be of significance. This move should not just be a small move. It should be either a bounce or a move through, and this market's going lower. It's turning the tide the other way. And that's the importance of trading near these energy levels, these levels where there are multiple reasons to trade. If you know that, there is a better than average chance of certainty that the price is likely to move away from the current level, would that not be an advantage to your trading? And the answer is yes. If the English is not good, the answer is yes to that in what I wrote here. But if you know that there's a better than average chance that the price is likely to move away from the current level, whether it moves to the upside or downside really doesn't matter to me. What really matters to me is that the market is going to move away from this level. That would be an advantage to your trading. And an example that I like to parallel to this idea, before we get into looking at examples and looking at charts, example outside the trading realm, actually goes to the good old blackjack table. All right, the blackjack table in Las Vegas. There are rules that they apply in Las Vegas and other casinos or whatever, and one of them is that if they anticipate that someone is counting the cards at the blackjack table, they're going to get thrown out of the casino. Well, what is counting cards? Counting cards in its most basic sense is kind of understanding what is left in the deck, not what is left. What happened, but it's more of the idea of what is left in the deck, and a good card counter in its most basic form, and I'm sure there's other ways, but we'll have an idea if the deck is hot with tens or a deck is not hot with tens. And when the deck is hot with tens, that creates an energy for that card counter. It creates an energy where he or she is now thinking in terms of taking advantage of that knowledge that there's going to be an energy because there's lots of tens in the deck. If the dealer gets a 5, there's an energy. He can double down on his bet in anticipation that the dealer's going to get a 10 and go and bust, because the dealer has to take a hit at 15 or at 16 or what, and if the deck is hot with tens, you can anticipate that there's a 10 underneath and that he's probably going to get a 10 and he's going to bust or a high level. And so, come and get him out. And the other thing is the other advantage comes if you yourself have 11, you can take a hit in anticipation they might get 21. Now, it doesn't mean that the dealer's going to get that level or he's going to bust. No. But what it does suggest is that there should be an energy that is going to put the odds of success in that traders or in that card players. It's going to increase the odds of success for that card player. And if the dealer suspects that they're counting cards or the croupier expects that they're counting cards, they're going to get thrown out of the casino. Well, in trading, you can put the odds of success in your favor by doing the same thing, counting the cards, counting the reasons to trade at a certain level. And that's going to create an energy. And it doesn't necessarily mean that you're going to win that hand. The dealer may, at 15, pull a 6 out of his hat and get 21, and you go down. But the chances are that the dealer is going to bust and go over, and you're going to win that hand. And that's an advantage to you. Same goes true in trading. Just because you buy against the moving average and the trend line doesn't mean that the market might go below that level and you lose a small amount. But that you're only going to lose a small amount on that trade. And in fact, you have the option to actually go short at the same time because the market broke through that technical level. So you actually have a bigger advantage, I think, in trading than a card counter does at the blackjack table. You have an idea that there's going to be an energy at that level, but you can continue to play the hand even when the cards are dealt. If the market goes through that level, and you bought against that level, you can close your position, go the other way if you really so desire. If you really think that there's going to be an energy at that level, and that, my friends, is how you put the odds of success in your favor, by trading near these energy levels. And if you're able to find multiple reasons to trade, you're better off. Now, let's take a look at some examples with all that idea and all that. We're going to spend the rest of the time taking a look at examples in the market. I want to introduce you to some of the tools that I use. I only use 3 tools. I use a moving average, and I already alluded to them. Actually, I have them. Oops. Now I did it. Have them. I have it labeled wrong, so I'll fix it here. There we go. You see my screen, right? Just someone give me a yes. You see my screen? You see the, yes, okay. All right. I'm going to introduce you to the tools that I use. The blue line represents the 100-bar moving average. The green line represents the 200-bar moving average. Since this is an hourly chart, this is the 200-hour moving average. This would be the 100-hour moving average. Okay, and they're both simple moving averages, not exponential and not anything fancy. They're just very simple. I find that the market tends to have an energy around these levels, and you can see an energy here, you can see an energy up here, you can see how it holds support, you can see how it moves. Even when this market's non-trending, it kind of uses the levels as support and resistance here. We break below the 200, you have energy, move to the downside, move above it, energy to the upside. And have a failure up here, the market moves down, back to the 100-bar moving average, energy moves to the upside. Well, anyway, let's focus here at yesterday's trade. And yesterday we had the gap down because of Cyprus, and for the rest of the day, the market actually, well, first off, on the opening, the market traded below this low from last week, or these lows from last week. We had the first low here, and we had the second low right here, and you guys see my arrow, right? I hope so. You see my arrow? Yes, okay, good. So we had a low here at 129.23 around on the 13th, and then we had a low at 129.10. And what did the market do? It opened up below, well, right up here and moved down, and we stayed below this 23 level. Then we moved below the 10 level, and we stayed below there, and we moved actually to new lows for the move. We moved down to the 128.80 level, and from there the market couldn't move any lower. There's support down below. Maybe I'll show it a little bit later. But there's good support down below, and the price moved back above our 10 level, and moved back above the 23 level. And once it started to move back the other way, an energy started to develop. An energy away from this area right here, from the 10 to the 23, and the market, lo and behold, moved higher. But anyway, I want to focus up here. And up here, where did the market eventually rally to? We rallied up to the 100-hour moving average. We rallied up to the Fibonacci retracement of the move down here. This was a high on Friday. This is a low yesterday, which is the day that we're talking about. And if you measure the Fibonacci retracements, this is the second tool that I use. You have the 38.2% retracement of this move. So this is basically this line represents 38.2% of this entire move. This line represents the 50% or the midpoint of this move. And I always put a little extra emphasis on the midpoint, or the 38.2, to be honest with you. Why? Because imagine a seesaw, and at the midpoint, everything's in balance. Well, if the seesaw is the market, if the price is above it, it's bullish. If the price is below it, it's bearish. So I consider this a key retracement level, the midpoint level at that level. So we have the 100-hour moving average, and that level comes in at the 129.90 level. And then we have the 50% retracement of this move to the downside. It comes in at 129.93. Only 3.5 pips separating the two. Now, the other thing of importance from yesterday's trade, which is a unique situation, is that the market from Friday's low, which is right here at around the 99 level, into the Friday's low was at 99, and the market gapped below that level. So there was a gap from, well, when the market opened here, from here to the low from Friday. And so there was this gap area. Everyone knows from trading that gaps eventually get filled, or gaps get filled. And so there is resistance against the gap level. And a lot of times the market will go up, fill the gap, and then rotate back to the downside. So at this, if we were just looking at this chart right here, and you were looking for a reason to trade yesterday, and you were watching the market move higher, and you're being patient because, that's your modus operandi is to find multiple reasons to trade. Well, Could you have known that these multiple reasons existed well before the price got up there? And the answer is yes. The moving average is easily seen, and it's seen coming down toward that level. Even right here, you can see that the moving average is moving down, and it was actually right at the 50% retracement right there, and it was in the vicinity of the 50% retracement. You can put your Fibonacci retracement in there and see that level, and you know that the gap exists as well just above that level. So you know that in this area right here, even when the market's down here or here or here, whatever, there is a good resistance up there. I do this all the time. When I come in the market, I will put a Fibonacci from a high to a low. I know my moving averages. I know that the market, gapped, and so I know that gap exists. And if I see multiple reasons there, I'm like, gosh, I hope the market goes up there. Because the bias is to the downside. 50% is a key level. 100-hour moving average is a key level. And filling the gap is a key level. So I'm sitting there saying, if I'm going to do one trade today, even without seeing, when we're in here, if I'm going to do one trade today and I need to have multiple reasons to do the trade, it's right up here. It's right in this area, right here. Would you agree? I would agree. I would agree that gives me multiple reasons to trade. Oh, I certainly agree, because I'm in charge of the show. So it gives me multiple reasons to trade and shows me that is the area that I want to be aware and prepared to trade. I always like to use the word be aware, be prepared. This is being aware and being prepared, finding those multiple reasons to trade. It's not hard to see. It's visual. I can see the 50%. I know that I can draw a line across there. I can see the 100-bar moving average. This is what you have to look for, ladies and gentlemen. This is how you have to set up your trades. 2 is better than 1. 3 is better than 2. 4 is better than 3. Find as many reasons as you can to trade against level. Use that level as an energy. Now let's see what happened. So if I would have traded, the market moved up to that level as we saw, and if I would have traded anywhere in this vicinity right here, where would be my risk? Remember, I said that multiple reasons or these areas where there's multiple reasons to trade, there's energy at it, but they also allow me to define risk. And for me, we had this bottom. This gap, the 50%, the 100-bar moving average, and I also add the 200-bar moving average. So the perfect risk-defining stop for me would be right here. If the market moved above the 200-bar moving average, 200-hour moving average, what would the chart be saying? It would be saying we're above the 100, we're above the 50, we filled the gap, and now we're above the 200-bar moving average. All those are bullish. I can stand moving above the 100-bar moving average as long as the price can remain below the 200-bar moving average. And I would prefer that the price finds sellers right here at the 99 or 93 level. So this is the area I'm going to sell, and I have a perfectly defined stop loss up here. If you don't have a moving average, or you don't have a Fibonacci retracement level, you can just say, if we get above, let's say the moving average is way up here, and you don't want to risk that amount on the trade. You can just say, I'll risk 10 or 15 pips on the trade. Because if it goes 10 pips above this area right here, chances are the price is going higher. Because there should be an energy at that level caused by these 3 things. In this case, I'm lucky because what do I have? I have the 200-hour moving average sitting right there, so I can do the trade anywhere in this vicinity right here. Let's say I do it at the 91 level, 91.5 level, and I'm going to risk up to this level, which is about the 07 level. So I'm risking 15 or 12, 91 and 01. So I'm risking about 16 pips on that trade. That's all I'm risking on the trade. And I know hindsight is 20/20, but and the market did in fact go down. But the point is, ladies and gentlemen, is that I knew this level existed. I knew I could define risk at this level. I knew I could limit my risk to 15 or 16 or 17 pips on the trade. I knew that if the market held that level, that there was likely to be some energy that would cause the price to move in the downward direction. Because if there's energy at a level, the market should move away from it. It's like the deck is hot with tens. There should be tens that start coming up. There should be tens in your trading that cause the market to go to the downside. So if I risked this amount on the trade, the reward is not necessarily as important to me as a lot of traders go. The reward is just what happens because of an energy level. And what I expect to happen, I expect to see the market to move away from this level. I have my stop. I expect the market to move away. I don't expect it to stay here. If it stays here, that would be unusual. That would be the dealer getting a 6 and getting 21, to be honest with you. So I would expect the market to move away. And if I did that, I can just sit here and I can manage a trade, knowing that that's key resistance. And I get good trade location up here. I'm really picking tops and bottoms. But I'm picking tops with a firm reason, understanding. And if I just waited and let the market do its thing, get below the 38.2, start to move down, start to move, and just move its, it was down for 1, 2, 3 hours in a row. It was easy trade. 1, 2, 3, 4 times. I'm risking this amount. I can make 4 times the amount, or a little more than 3 times the amount. And lo and behold, where does the market go? Remember, we started down here when the market opened up below the 23 level, below the 10 level, or we started at the 23 level, moved below that level. Where the market finds support? Right at the 23 level. Is there a multiple reason to get out at that level? Yeah, this low. This resistance area. There's actually three levels. This resistance area initially on the day, we moved above that level. I know we went to 22 or something here, and maybe went to 21 here on this move to the downside. But there's this area is where support is. Key support. Last week's initial low, this week's low, this week's high, this high on the opening. In addition to that, I can move a Fibonacci in here and put it from the low to the high here and measure down. And where does the 61.8% retracement cut level come at? 129.24. So I can be prepared and understand that this is going to be a key support level for this reason, for this reason, for this reason, for this reason, for this reason right here. All these reasons kind of line up and allow me to pick a top and almost even pick a bottom if I'm lucky enough to stay in that position for that long. But the point is, I didn't really have to risk much at all. I didn't have to risk much at all. The reward kind of took care of itself. Why? Because there's an energy at that level. Energy at that level. Look for levels that have energy. Be aware. Be prepared. Map them out beforehand and look to trade against them. Now, there's other ways that you can find even, I don't want to say there's a even a better chance of success in trading, but imagine if you find multiple reasons to trade on multiple time frame charts. So, for instance, you look at the hourly chart and you see a level that is a key technical level, and then you go to a daily chart and you see a level that is a key level as well. If you look at an hourly chart, guess who looks at hourly charts? More swing-type traders. If you look at a daily chart, who looks at those? More longer-term traders. So you have two buckets of types of traders focusing on the same technical level. And that increases the chance of your success as a trader. And there are ways that you can be aware and be prepared and find these multiple levels as well. So let's take a look. Let's take a look at the chart here. This is the daily chart of the euro versus U.S. dollar, and I want to build the case here. So, or for finding multiple levels to trade just off of this chart to begin with. Okay. So, and then we'll take a look at other time periods. Okay. So the first thing I did was put in a trend line, okay, because trend lines are visual. Everyone can see that. Everyone can see that the market is moving up here. Everyone can see that that if you connect a low to a low, it connects to a low here and a low here and a low here and a low here. Do you have enough reasons to think that this trend line is a good trend line? Again, this is a daily chart, okay? So during this period right here, I know they're successive, but the market found support here, closed here, and then it came back down and found support, and then it went up a little bit and it came back down and found support, and then it came down here and found support and took off to the upside. So this is a key technical level. Now let's so those are all those levels right there. Oops. And then let's look at what the market did here. And the market came down, and we found support, or found 3 days where the market basically had the same bottom right here. Why did the market bottom there? Well, because of this reason. Boom. Fibonacci retracement. Measure the low to the high move. This is the trend move defined by the trend line. Market moves here, and what's at that level? 38.2% retracement level. So at this point right here, 133.09.2, let's call it 09. Was there multiple reasons to trade at that level? Yes, we had the trend line, which had 1, 2, 3, 4, 5, 6 points on it. We had these lows, 1, 2, 3 lows in this area right here, and we had the 38.2% retracement of this move to the upside. So this level on this day and going forward should have had an energy at that level. If the market broke through that level, it would turn the bias from on the daily chart to more bearish. Now I say more bearish because you could have drawn a trend line here and we broke through that trend line, and so it was somewhat bearish there. But this is more bearish, and this is an important level. Why? Because lots of reasons at this 133.09 level, right? Lots of reasons at that level which make it a low risk trading opportunity. A level that if it goes below, you expect the price to go lower. If it bounces off it, you expect the price to go higher. So it's just a matter of listening to what the market says. And if you went long at that level, get out and go short. If you went short at that level, when it broke through that level, put your stop above and maybe use a shorter term chart or whatever at a reasonable level. You shouldn't see the price move back above that by 15 pips. Just as a rule of thumb. If you break through a trend line, a Fibonacci retracement, a low, you have all these reasons for it to go lower. It should go lower. All right? It shouldn't go higher. All right, so multiple reasons to sell at 133.09. Now, let's expand on this and take a look at the same day. This day actually came in on February. This day was February 20th, okay? And it's weird the way that comes in, but let's take a look at the 5-minute chart. At the 5-minute chart, and we'll get down. Here's our 09 level, by the way, 133.09. Okay, that was a level off the daily chart where the market went below that level. But let's just backtrack and take a look at the 5-minute chart, and let's see what the 5-minute chart was saying on that day, and see if there are multiple reasons to trade on this day. So, off this 5-minute chart. I look at the 5-minute, I look at the hourly, I look at the daily, and 5-minute charts. If a lot of times it gives you. If technical levels start to line up there and the market's non-trend, it gives you some really nice reasons to trade, multiple reasons to trade. You just look for the energy on the break or on the bounce. And in this case, what do we have in the 5-minute chart? We have 1, 2, 3, 4 along a nice little trend line. So, and there's probably more. There's just 4 areas where the market held. There's like 5 or 6 right here. And so there's a nice little trend line developing there. What else do we have on the top? We have 1, 2, 3. We have this is a parallel. This is a triple top, right? This is a horizontal line going across tops. It comes in around the 134.30 level, 31.30. There's about a pip or so separating. This is like 31. This is 29.5. This is 30.5. 3 separate areas, 3 tops. We have the blue line that represents the 100-bar moving average on the 5-minute chart. We have the green line represents the 200-bar moving average on the 5-minute chart. The difference between this, and this is 10 pips. 100 bars at 15, trend lines at 11, 200 bars at 5. 10 pips. We had a clue up here that the market was had a triple top. Is that bullish or bearish? Can't get above the high 3 times. Boom. It's better than a double top. Triple, 2 is better than 3. Some people trade off a double top, I don't. But a triple top, yeah, that's giving me a clue that if we break below here, here, or here, this area, all right, it doesn't have to be the same area like the 133.09 level, just the whole area. If you can define an area, 10 pip area, that if you go below, you want to trade, especially when it's giving you a sell signal up here with a triple top. So you look for that area. You are aware, prepared, having multiple reasons to trade, just by using simple tools, trend line, Fibonacci trend line, moving averages in this case, horizontal trend line, or a triple top. And the market goes down below that level. If you traded when the market went below the 200-bar moving average, where would your stop be? Where would you define risk? If it moves above here. So the answer to your question, Boinky, what do you do about false breakouts? You lose. You lose. If the market went below this 200-bar moving average and went below the 100, went below the trend line, went below this level, and you sold this break right here because there was a cluster of reasons to sell, including the triple top, including the 100, including the trend line here, and the market went below here and then moved back above the 100-bar moving average, what do? You get out. In fact, the chances are the price isn't going lower, it's going higher at that point. That's the importance of multiple reasons. You should see an energy, whether it's to the downside and you get a false break to the downside and the market moves back to the upside. Like here's a false break, right? This is a false break above the 100-bar moving average. The market stayed below the 100-bar moving average all through here. All these bars. We finally get a consolidation, a correction, and the market moves above here. Boinky, where's your next target? Right here. Where's your stop if it goes below here? How do you know you're really wrong when it goes below here and it comes back up here and it starts to go down there? You better get out. You got lucky that the market went down here and came back up here after just spending 2 bars above. You better get out. And if the market moves around, or if it all of a sudden starts to just go sideways, just exit. That's saying the market's it doesn't know what it wants to do, and it's getting, So don't you're going to lose, okay? No one's guaranteeing they're going to win. But I'm just trying to put the odds of success in your favor, just like no one's guaranteed that the dealer's not going to pull a 6 and get 21, right? Same thing in trading. You're going to lose, but you have this idea that this energy is going to happen at this level for all these reasons. So line up the reasons, do the trade, put your stop in above the 100-bar moving average somewhere. The price should not go above the 100-bar moving average. If it gets through all this stuff and shows all that, it should not. If this market is worth anything, it should not go above that level. And because this is very visual, the 100-bar moving average is very visual, so is the 200. A lot of people use them. And the triple top is very visual. There's no reason for the market to go higher. And if it does, get out. And so the market goes lower. And it starts this whole trend for these 4 reasons. Now let's look at the same chart, and let's say you missed that, Boinky, and you missed this move to the downside here. Well, let's watch for these retracement. So I put a Fibonacci retracement in here, and we have the 50%, the 38.2 to 50% retracement level right there. This is what I call a correction zone. In a trending market, if the market holds a correction zone, that's bearish. What's right here? 100-bar moving average. What's right here? 200-bar moving average. Cluster of resistance right here. Market should not go above those levels. If you miss this opportunity right here, sometimes it gives you another chance right here. be aware this happens all the time at tops and bottoms. The market moving average starts to move down, starts to get flat, trend lines start to get broken, you get triple tops, you get these little moves to the downside. Someone says, oh, well, I sold the market and I bought it, and I made this amount. You're saying, this is the end of a trend. This is going lower. This is the end, folks. It was non-trending here. Non-trending is going to lead to trending. So you are saying, all right, go up to 133.95. Give me the confirmation, and you sell the market, and that goes down there. All right. So now let's take a look at. Remember the 133.09 level? That was the level off the daily chart, right? That 133.09 level, and we'll take a look at that. Or we'll take a look at that in a second. So here the market goes down, and we get this big bar to the downside. So some news came out, right? And this is the biggest bar in the whole move to the downside. But we get a correction here. I'll measure this trend move right here. I don't measure from up here. I'll measure the trend move right here. Why? Because sellers are in charge here. If sellers are going to remain in control, they're going to keep the price below the correction zone. Sellers are in charge. They get a 38.2% off sale at Macy's or John Lewis or wherever you're at. And they sell. They come back in the market and they say, I'll take 38.2% off or 50% off just as long as you stay below that level. That's fine. Well, look at where the level comes in at 133.08. Now, if you were smart enough and you were aware and prepared, and you're looking at the 5-minute chart as well as the daily chart, that 133.09 level right here is a key level on the daily chart, and it's a key level on this retracement of this move here, of this fast and directional move to the downside. So you have not only the 38.2 and the 50% retracement here of this move to give you a reason to sell, but you also have the daily chart here where we have all that stuff coming in there at the same point. So that's where the market now has multiple reasons to trade at a level on multiple charts. And again, that is a level where you as a trader want to take advantage of it. So look for these clues. All you need is look at 3 different charts, draw trend lines, Fibonacci retracements, and have your moving averages in there. And then look for multiple reasons. It's like counting cards. All right, let's take a look at the Aussie versus U.S. dollar here today. We have the hourly chart up here. This is the last trend move to the upside here. It's not a clean trend. It's a fast move. We had the Monday come in. Market moved higher yesterday. And then today we came down, and where did we come down to? The 100-hour moving average. Also at that level is a 38.2% retracement at the 103.62 level. So we have multiple reasons to trade off this hourly chart at the 103.62 level. Now it went a little bit below it. Where'd we go? We went to about 59. I don't suggest buying 62s or against some multiple reason and selling 59s. It's a little bit too close. You should give it a little bit more room. You want to see the market, especially when the market's coming down pretty good here. Market's coming down pretty good, so it has a head of momentum. And traders who are momentum traders are just like, oh, this is going down, da 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 da, and they don't know that there's multiple reasons here, like the 100 bar and the 38.2, but you do, okay? And so you're a better buyer down here with the stop. I don't know, maybe down below the low here. It's a little less clear where your stop is, but worst case scenario, you're risking down to 46 if it goes below the 50% level. So 46.56, 16 pips. Okay. So that's the worst case scenario. Maybe it's not even more, but I just want to find an example here today for you. So there's a 100-hour moving average of 38.2. Remember, the thing that we don't know about any trade is what may happen afterwards. So if it holds support here, we don't know how far it's going to go to the upside. What we only know is that we have defined risks to the downside. No one really knows the reward. People think they know rewards. They say, I'm going to put this trade on and I'm going to have a reward that's going to take me all the way up to 104.811. You don't know how far it's going to go. That's a possibility, and that certainly is a target level. But we need to get back above this, this broken trend line. We need to, and then we need to get above the close from yesterday, and then we start to go toward that level. What we do know is risk is defined against this level. And by the way, if you have risk here, if your risk is originally there, and you see the market bounce come up here and test the underside of this trend line, are you going to continue to have your risk here? No, you're going to put it right below the 100-bar moving average or below the 38.2. It shouldn't go back below that level. Initial risk, adjusted risk after the market does what you think it should do. So this is what happened here today. The market bounced off that level, moved higher. Now let's look at the daily chart for today, and let's look at the low for today. And the low for the day today also had the 200-day moving average there. That 200-day moving average came in at the 130.60 level. Where was the hourly chart? 130.62, 38.2% retracement, and 100-hour moving average coming right there. Where was the daily support? 130.60.5. Do you understand why when the market went down a little bit below the 62 level to about the 60 level, why the market turned around at that level? Because the daily traders were looking at the 200-day moving average, and they could define risk against that 200-day moving average. They could also define risk against the 50% retracement of this move to the downside here. So that other move was looking for this, looking at the this move to the upside here, the most recent move to the upside, which is really from this low to here. This is taking a look at the daily chart, and we have the 200-day moving average. We have the 50% retracement at the 103.55 level. And so risk was the if you were aware and prepared. If you were looking at the market and understanding before the market even got there, and you saw the market moving down sharply and coming down and breaking through this trend line, where would you think support would be on the hourly chart? At the 100-hour moving average and at the 38.2% retracement. And then you wander over to the daily chart, and where do you think support comes in? Oh, the 200-day moving average and the 50% retracement. So now your risk is buy at 62, put a stop below the 55 level. If we go below the 50% retracement level, somewhere, 55, 53, 52, 51, it's likely the market is going to have an energy more to the downside than it is to the upside. But if you're able to buy against that level off the hourly chart and off the daily chart, you have good trade location. We don't know how far the market's going to go up. We know we have to get back above this trend line. We know we have to stay above the 38.2, the 100-bar moving average, and the 200-day moving average. That's your stop. But we have good trade location that could lead to a rise to the upside, a further rise to the upside, or we get stopped out and we lose a little bit of money. The goal is to risk a little, make more than a little. The goal is to put the odds of success in your favor so that you're able to have more winners and losers. So that you're able to take advantage of the energy at that level. So that you're able to understand that you're either going to be wrong really quick or you're going to be right, and the market has the potential to move in the direction more than you risk. I like to say risk a little, make more than a little. So I'll be happy to take any questions that you may have right now. I see a question coming in, EMA or SMA. My rule of thumb, Suzanne, is that keep it simple to be successful. And I know people think, well, the EMA is better than the SMA. To be honest with you, it's probably 6 of one, a half dozen of the other. But the one thing that gives me, puts me makes me more focused on the simple moving average is I can explain it to you. Explaining exponential moving average, well, it weights the earlier part of the, and people, how does it weight it? How does it do it? What's the math? I don't understand the math. Simple moving averages, you take all the closing prices, you add them up, and you divide by the number, and you get the number. People understand that math. They don't understand the EMA. The other thing is that if you listen to the Bloomberg TV or if you listen to CNBC, they'll typically just look at the simple moving average. So one of my rules of thumb is the more people that watch it, the better off it is. So I use a simple moving average all the time in my trading. And once again, if you expect the market to bounce off that level, sometimes it may go a little bit below it, but there may be another reason why it went a little bit below it and want to test this level, or a lot of times also it may come because the market is moving sharply to the downside, like it was in the Aussie dollar here today. It was moving, fairly trend-like to the downside, and eventually we get to a support level, and so you get those momentum traders who are like, this is going lower. Next thing you know, they don't know that the 200-day moving average is there, and the market bounces off that. How do you okay, I'll finish up. How do you handle economic data releases and news? If there's a key economic release that I think that the market has the potential to gap, I won't trade. I don't suggest that you trade it. There's more risk at that time. But the way I do it, in short, is that I will prepare myself to look for these multiple levels to trade. So let's say a key economic release is coming out, and the market and the market's up here. I will know that this exists. I will know the levels above and below where there's multiple reasons to trade, and those are going to give you clues after the risk, after the event, after the liquidity risk, and you go from there. So just constantly look for it. I don't necessarily say. Or if you have profit in a trade, you can keep the position. You're risking your profit, and hopefully the market will move. If you have a losing position, don't take a position. If you don't have a position, look for the multiple reasons to trade. You're always looking for the next trade, folks. There will always be another trade. I want to thank everybody. I want to thank the people at FX Street for allowing this to happen today. And I look forward to next month when we do it again. My name is Greg Michalowski, Currency Analyst for FXDD, and proud and happy contributor to the FX Street webinar seminars. Thanks again, everybody. Really appreciate it. Bye-bye now.